Hey everybody, Courtney Smith here. In March of 2019, I wrote a publication called Financial Crisis. And in it, I talked about how the financial crisis would start in March of 2020. And it did. It was triggered by COVID, but it was going to happen anyway. One of the major problems that we're in the process of starting right now and is going to continue to get worse is debt. We've got record-setting corporate debt. We have record-setting state and local government debt. We have record-setting federal government debt. What we don't have is record-setting personal debt, but it's starting to get bad as well. Today's Wall Street Journal, which is a highly recommended publication to subscribe to, has an article in today's paper saying U.S. states face biggest cash crisis since the Great Depression. Now, I talked about this in March of 2019, but this is an excellent update to what I wrote in that essay. What we're talking about here is nationwide, the U.S. state budget shortfall from 2020 to 2022 could amount to about $434 billion, according to Moody's. Now, that's actually not that high, but for state and local governments, that's very high. That's greater than the 2019 education budget for every state combined, or more than twice the amount spent that year on state roads and other transportation infrastructure. So relative to the size of state and local governments, this is a disaster. A disaster. Now, and I'm going to talk about what can these states do about it. I'm going to tell you how we can make money from it. Okay. So they say here deficits have already prompted tax hikes and cuts to education, corrections, and parks. State workers are being laid off and are taking pay cuts, and the retirement benefits for police, firefighters, teachers, and other government workers are under pressure, although they haven't been cut anywhere. Here's an example of what we have here. Change in tax revenue. So this is 2000. There was a recession in 2000. Here's the 2008 recession, but you can see so far this year down even more than 2008. And remember, 2008 affected property tax rates because the value of people's property dropped so much. Okay, so here's where the problem comes in. So first of all, as this article highlighted, there's layoffs. There's shutting down of state and local services. And of course, they nearly always shut down the ones that are most visible because they want to put pressure on the citizens to give them tax hikes and things like that. So parks are always first. Parks are also considered not essential, let's be clear. All right. So what can they do? Well, here's the problem. They can raise taxes. But raising taxes in the middle of a recession, taxes reduce economic growth. So they can do it, and they will do it. But that doesn't help the economy. It doesn't help you. It doesn't help me. All right? So that means that governments don't like raising taxes because they usually get kicked out of office. But they're going to do it anyway because they're under severe stress. Another place they're going to get the money is rainy day funds. Most states actually have a rainy day fund that they use where they store money away in good times so they can use it in bad times, which is really prudent fiscal planning. But I noticed there was something in here. Even after the rainy day funds are used, Moody Analytics projects 46 states coming up short, with Nevada, Louisiana, and Florida having the greatest gaps as a percentage of their 2019 budgets. Now, I'm in Nevada as I record this, and Nevada is having to cut back, use their rainy day fund. But here's the amazing thing. They'd actually be running with a balanced budget if they cut spending to where it was just 2 years ago. In other words, they've increased their spending so dramatically in the last 2 years that in a way they don't really have to cut very much. It's actually a lot, but they only have to cut back to where they were 2 years ago, and the budget would be balanced. Okay, but still, they don't want to do that because they're politicians. No politician likes to cut spending. In fact, it's against their religion, I think. So we're going to see increased taxes. We're going to see increased fees. So the fees to buy a hunting permit, DMV fees, they're all going to go up $10, $20, $30. Tickets. There's also a thing called taxation through compliance. The police are going to be given quotas. They won't be called quotas of how many parking tickets and speeding tickets they have to get out, because that's a big source of money. It pays for the police departments, which is a big expense, mainly for local governments, but also, state highway patrol and so on and so forth. We're going to see some cutbacks. We talked about that. But what about the debt of all these places? Here's the real problem. You see, the federal government technically could default, but why would they? They can just go in the back room and print up more money and pay off their debt. So they're never going to default in the United States. State governments can default, okay? They can default. And we may see some in the states which have particularly bad fiscal policies, like Illinois, New York, and to a certain extent, California, New Jersey, Connecticut. Okay, those are the states that are really disasters or borderline disasters. The other states are better, but not good. What about bankruptcies? What about declaring bankruptcies? Well, states can't declare bankruptcy. You see, I don't want to get too esoteric here, but bankruptcy is a corporate thing. So cities can declare bankruptcy. Villages, townships, municipalities, they can all declare bankruptcy and not have to pay their debt, because a city is actually a corporation. Okay, they have to go to the state and ask permission to form a corporation, and the corporation is the city. It's a particular type of corporation, but cities and localities can declare bankruptcy because it's a corporate thing. But states can't declare bankruptcy. There's no bankruptcy law for states, but they can default. And I think we're going to see some. I'd say Illinois probably comes first in the hit parade of states that default. The problem is the other thing too is, let's say we start to get defaults from state and local governments. What that's going to do then is create a ripple effect throughout society, because state and local bonds are very important. Muni bonds is the usual term for many of those bonds. Maybe most of those bonds are muni bonds. And all of a sudden, we're going to have junk muni bonds. They're going to be defaulted on. And as a result, you're going to start to see interest rates skyrocket. I shouldn't say skyrocket. That's exaggerating. I never want to exaggerate here. We always want to be reality-based. They're going to go up a lot. How's that? All right? And as a percentage, they're going to skyrocket. As maybe they only go up 2%, but if you're only paying 0.25%, that's a 10 times increase. That's skyrocketing. So that's going to have a big impact. Now, then that has a big impact on corporate debt, which is astronomically high right now, highest in history, and we're supporting massive numbers, thousands and thousands of zombie corporations who all of a sudden, they can't pay their interest and principal right now. They definitely won't if interest rates go up. They'll just go even worse, and therefore increase corporate bankruptcies. Are you following the linkages here? Okay, those are the linkages that are going to happen. The state and local governments, they lay off some people. What does that do? Well, those people aren't making their rent. They go on welfare. They go on unemployment, etc. And then that creates all new problems. So this state and local government is a crisis. The debt is higher than it's ever been. The income that state and local governments are receiving is down dramatically, as you see at the chart at the bottom of the page. Layoffs are coming. Tax hikes are coming. Tax hikes create poverty, by the way, in a society, because you raise taxes to the point where people can't work anymore because it's not worth it. Let me give an example. If you're earning this much money and you pay this much tax rate, if you earn $1 more, your tax rate jumps up a lot. So actually you're earning less after tax. And that's what inflation does. But also by raising taxes, it bumps people into higher tax brackets and therefore reduces their wealth and their income. That's not good for society. We want all people to make more money and have greater wealth. Taxes do not do that. So this is a crisis. This is part of the unfolding of the financial crisis that I wrote about back in 2019. Now, I updated that report in September of 2019, so it's getting a little stale, quite frankly. But there's a link below. You can get a free copy of the most recent version of that, which gives you the overview. And you can see I predicted exactly this was going to happen in March. But this report you'll get is from September of last year, so a year ago. But nonetheless, that report lays out what's going to happen. And therefore, you can protect yourself and profit from it. So please, get the free report. All right, everybody. Talk to you later.